Welcome to the deep dive.
Pull up a chair. Today, we're sorting through quite a pile of stuff: financials, strategy docs, analyst takes, all centered on Indorama Ventures, IVL, big global chemicals player.
That's right. We've got the latest numbers, Q1 2025, plus what they said at their capital markets day about, the future strategy and what the analysts think.
Yeah, so our job here, our mission for this deep dive, is really to cut through all that detail. We want to get the core story. What's the climate IVL's operating in?
Mm-hmm.
What challenges have they faced? What's this big IVL 2.0 thing all about? And, what might be coming down the pike based on what they're saying and what the market watchers think.
Exactly. The idea is to pull out the really key bits, the numbers that matter, the strategic thinking, so you can get up to speed quickly on where IVL is and where it might be headed. Let's unpack it.
Okay, let's start with the backdrop, the big picture. To really get IVL's recent performance, you have to understand the world they're working in. These sources, they paint a picture of a pretty tough Q1 2025, don't they? Well, absolutely. The macroeconomy was, well, a major challenge. The reports talk about sluggish global GDP growth, interest rates staying high, and all the geopolitical uncertainty kind of hanging over industrial activity everywhere.
And what about specifically for petrochemicals, their industry?
Yeah, that's where you see the specific pressures really biting, according to these documents. Demand downstream, so from their customers, was weak.
Okay.
Then there's this issue of global oversupply just sort of persisting, which really hammers industry spreads, the margin between their costs and selling prices.
Right.
Plus high energy costs, especially hitting their Western operations. And interestingly, something about freight rates.
Yeah, what was that? Lower rates sound good, usually.
Well, the sources note that the big drop in freight rates actually made imported finished goods cheaper, more competitive. So that puts pressure on domestic producers like IVL.
Ah, okay. Harder to compete with imports. So, given all that pressure, how did it actually translate to IVL's financials? What did Q1 2025 look like on the books?
Well, actually, maybe just a quick look back at 2024 first. The reports mention it. Their operational earnings, EBITDA, it actually went up in 24 compared to 23, partly their own self-help efforts.
Okay, so improving operationally.
Yeah, but, and this is a big but, they were expecting a massive net loss for the full year.
It's so massive.
Something like 19.3 billion Thai baht. But the sources are clear. This wasn't really about operations collapsing. It was mostly huge one-off asset impairment costs.
Ah, restructuring write-down.
Exactly. Around 20 billion THB worth. So underlying operations were actually improving year on year in 2024, despite that big accounting hit.
Okay, good context. So 2024 had those big write-offs, but the core business was getting better. Now, let's get to the most recent quarter, Q1 2025. How did they do?
Right, Q1 25. Total revenue is $3.487 billion US dollars. That's about 127.3 billion Thai baht. Now, that was down a bit from the previous quarter, Q4 24, but down more significantly year on year, about 9%.
Okay, 9% down year on year. What drove that decline?
The sources mainly point to lower production volume. That was down 6% year on year, 5% quarter on quarter. Two main reasons given.
Which were?
Planned maintenance shutdowns at a couple of their big intermediate chemicals plants, and also the impact of that really severe cold snap in the U.S. earlier in the year, that hit operations. Sales volume was down too, naturally.
And the bottom line, profit or loss?
It was a net loss for Q1 25. They reported 1,312 million Thai baht loss, which is quite a swing from the same quarter last year when they actually made a profit.
Oof, okay. A loss. What about that operational profit metric, the adjusted EBITDA? How did that look?
Yeah, this is where you really see the hit. Adjusted EBITDA came in at $276 million US. The reports flagged this as being lower than what analysts were expecting, and it was down significantly.
How
A
significant?
sharp 23% drop from the previous quarter, and a pretty painful 30% down compared to Q1 last year.
Wow, 30% year-on-year drop in operational earnings. That's brutal. What exactly caused such a big hit besides the general environment?
The reports really zero in on the performance in their CPET segment. That was flagged as the main driver for the operational earnings decline.
Okay, CPE. And within that segment, and maybe intermediate chemicals too, what were the specific pain points?
It seems like it was a few things hitting at once. Those planned maintenance shutdowns we mentioned at critical spots like the Lake Charles cracker and the Clear Lake glycol plant that directly cut their output.
Right, production offline.
Then you had the market pressures, squeezed margins, benchmark spreads on core products like integrated PT and MTBE, plus Those lower freight rates making imports more competitive, as we discussed, and energy costs still relatively high. It was just a really tough mix for those parts of the business in Q1.
Okay, so a challenging Q1 indeed. Net loss, that big drop in adjusted EBITDA, really hit hard by specific segment issues, maintenance, and market conditions. But was it all bad news? Were there any bright spots, anything positive tucked away in those reports?
Yes, definitely. And this is important. It wasn't uniformly negative. While some areas clearly struggled, other parts of IVL showed, real resilience, even growth. It suggests some of their internal changes might be working elsewhere.
Okay, like where? Which bits did well?
Well, Indovinya stands out. That's their downstream chemicals business.
Hmm.
Its adjusted EBITDA was actually up significantly, 10% quarter-on-quarter, and an impressive 18% year-on-year.
18% up. How?
The sources put it down to better fixed cost efficiency and, crucially, more profit coming from their HVA products.
HVA, high value added.
Exactly, the more specialized, higher margin stuff. Selling more of that seems to have really helped Indovinya buck the trend. And the fiber segment, too, it also saw strong growth in operational earnings.
Oh, strong.
A jump of 43% quarter-on-quarter and 22% year-on-year. They said that was driven by higher sales volumes overall and particularly good profit performance in their hygiene product group.
Okay, so some real strength in those higher margin specialized areas. What else looked positive, despite the tough quarter overall?
A really key positive highlighted across the sources is their progress on costs. Overall, fixed costs were down,
Compared to when?
compared to both the previous quarter, Q4 24, and Q1 24.
How much lower? Do they give numbers?
Yeah, about $5 million down quarter-on-quarter, and a pretty chunky $30 million down year-on-year. And the sources explicitly link this to their asset optimization program and management actions. So, evidence that the restructuring is actually starting to deliver savings.
Right, $30 million is definitely real money. What about cash? How did cash flow look?
That was another positive. Cash flow from operations improved quite a bit in Q1 25, up to $416 million US. They had a very strong EBITDA conversion rate, 152%. The reports say this was mainly due to working capital levels getting back to normal.
Okay, good cash generation. Did that help with debt?
It seems so. Even though they were still spending on capital expenditure $183 million in the quarter for maintenance and growth, they actually managed to cut net debt
By how much?
by $100 million US compared to the end of December 2024.
So, cutting costs, generating decent cash, paying down some debt, even while investing and navigating that rough market. It's definitely a more complex picture than just the headline loss suggests. What about their overall financial stability metrics? Liquidity, debt ratios.
Yeah, the reports point to a solid liquidity position. They had $2.2 billion US in cash and equivalents at the end of March 25. On debt, the key metric analysts often look at, adjusted net debt to equity, was 1.39 times.
Which is considered.
Generally manageable for a company this size in this sector. They also reported a debt service coverage ratio, DSCR, of 1.24 times, suggesting they had enough earnings to cover debt payments. One source also gave a higher stated DE of 2.90x, which likely reflects the total balance sheet view without certain adjustments.
Okay. So battling headwinds, taking hits in some core areas, but also showing progress on internal fixes like costs and debt and strength in other segments. This leads us neatly into their big strategic response, this IVL 2.0. What exactly is that based on the sources?
Right, IVL 2.0. It's described as this big 3-year optimization plan. The stated goal is basically to revitalize the whole business, get it back on a growth path, and adapt to what they see as a fundamentally changed global business environment.
And the sources keep mentioning a really fundamental shift in how they plan to grow going forward.
Yes, this seems to be the absolute core of it. It's a huge pivot in their growth strategy, arguably. IVL built its empire over 20 years, largely through M&A, right? Over 50 acquisitions created their integrated model.
50, wow. So they're stopping that.
They're shifting focus dramatically.
Yep.
The sources say they're moving away from that M&A-driven growth model. The new emphasis is on growing through strategic partnerships with other major industry players.
Interesting. Why the change? Why now?
Well, the thinking seems to be that this partnership approach is just, well, better suited for today's more volatile world and also for where IVL is now as a company after all that acquisition activity.
So the goal is?
The goal is to leverage everything they're building under IVL 2.0, the revamped organization, the better processes, the systems. Use their brand, their indispensable chemistry line, and create this network effect through partnerships. Basically, capitalize on mutual scale, build dominant positions together in key markets, but without IVL having to do all the heavy lifting and capital outlay of buying companies outright.
Okay, that makes sense. Do the sources give any concrete examples of this new partnership strategy in action yet?
Yes, there's one clear example mentioned. Back in February 2025, they bought a minority stake around 24.9% in an Indian company called EPL Limited.
And EPL does.
They're a big player in specialty packaging in India, particularly laminated tubes. The sources point to this as exactly the kind of move targeting a high-growth market like India, but doing it collaboratively, not via full takeover.
Got it. Any other big structural changes under this IVL 2.0 banner?
Yeah, the reports also reiterate something they've talked about before, the plan to potentially spin off two business segments. Indovinya, the downstream chemicals unit that did well in Q1,
Right. Yeah.
and Indovita, which is their packaging business. The idea is these could potentially become separate independent companies, maybe better able to chase their own growth agendas.
Okay, so a lot going on there. Cost cuts, debt reduction, this major shift from M&A to partnerships, potential spin-offs. It's a lot of moving pieces. Based on what you read, what's the outlook? What do they expect going forward?
Well, the company itself sounds pretty confident about things improving, especially looking just ahead to Q2 2025.
What's driving that optimism for Q2?
Two main things mentioned. First, just getting back to normal production levels now that those big planned maintenance shutdowns from Q1 are over. That should boost volumes. And second, they're anticipating that industry spreads will start to improve.
Why? What would make spreads improve?
The expectation seems to be driven by potentially lower raw material costs, combined with maybe some pickup in market demand as the year progresses.
Okay, that's Q2. What about the full year 2025 outlook?
The general expectation laid out in the sources is for a strong recovery through 2025. A few key reasons cited for that. Well, firstly, no more of those huge one-off charges like the impairments that dragged down the 2024 results. Second, they expect sales volumes to rebound. And third, there's a general feeling that those product spreads probably hit their low point and should gradually improve through the year.
And how do the internal changes, the IVL 2.0 stuff like restructuring, feed into that 2025 outlook?
Those ongoing optimization efforts are expected to deliver pretty significant cost savings. The sources estimate around $170 million in savings for the full year 2025, just from those actions.
Okay, substantial savings. Are there other financial moves planned to help shore things up or fund this?
Yes, definitely. They're planning to sell off some non-core assets. They expect to raise about $300 million from that. And then there are those potential IPOs we mentioned for Indovinya and Indovita.
Right, the spin-offs.
They're hoping to raise around $1 billion from that fundraising activity. The idea is to use this cash to further cut debt and strengthen the overall balance sheet, especially getting Indovinya in good shape ahead of a potential IPO. They also mentioned refinancing about $2 billion in debt during 2025, mainly to give Indovinya flexibility.
So operational improvements, cost savings, asset sales, potential IPOs, a multi-pronged approach to recovery.
Right.
How are the outside observers, the analysts, viewing all this?
Generally positively, based on these reports. Several analysts apparently have buy or trading buy ratings on IVL. They see it as a top pick within the petrochemical sector right now.
Do they think the market gets it yet? Is the recovery priced in?
They acknowledge the stock price has moved up already, reflecting some of this expected recovery, but many still see significant potential upside from where it is now.
And what's underpinning that analyst optimism?
Pretty much the same factors we've been discussing. The expected profit rebound in 2025, the impact the cost cuts really showing up, the hope for improving market spreads, the potential value creation from the IPOs and asset sales, and also just looking at the valuation.
What about the valuation specifically?
Well, one source mentioned that based on forecast 2025 earnings, metrics like the price-to-book ratio look, not expensive, maybe even below the industry average, suggesting there's room for the stock to grow if the recovery plays out as hoped.
Any particular market catalysts analysts are watching closely?
Yeah, they mentioned the China play. Basically, any signs of stronger demand from China, maybe driven by stimulus or better trade news, would be a big positive for the whole sector, including IVL. They also noted that PT spreads have actually ticked up recently, which supports the positive narrative.
Okay. And I think there was a quick mention of ESG performance as well.
Yeah, just briefly, the sources note that IVL scores well on environmental, social, and governance factors, recognized by groups like S&P Global and included in sustainability indexes like the DJSI. So that's another positive aspect they highlight.
Okay, wow. That was quite a journey through the sources. We
Yeah.
started with that really difficult global and industry picture IVL was up against.
Hmm.
Then we saw how that translated into the Q1 financials, the net loss, the drop in operational earnings, particularly in those key segments like CPET.
Right, but then we uncovered the other side of the coin. The bright spots. Indovinya Fibers doing well. Real progress on cutting costs, better cash flow, debt coming down.
Yeah.
Showing those internal actions are having an effect.
And then the big strategic shift, IVL 2.0, moving away from that decades-long M&A habit towards partnerships, focusing on optimizing what they have, maybe spinning off parts of the business, a fundamental change in approach.
Exactly. And we finished by looking ahead. The company's own expectation for a strong recovery in 2025, driven by operations normalizing, market improvements, cost savings, and boosted by those big financial moves like asset sales and potential IPOs. And importantly, that view seems to be shared cautiously by market analysts.
So the core story really feels like this huge global company actively tackling major headwinds, not just weathering the storm, but fundamentally restructuring and changing its growth playbook, betting that optimization and collaboration is the way forward now, rather than just acquisition.
Absolutely. And maybe, as you think about all this, here's something to chew on. How might this shift by a mature giant like IVL, away from constant buying towards partnerships and internal focus, reflect a wider trend? Could it be that for established companies in these volatile times, unlocking value by leveraging what you already have and building connections, rather than just buying more scale, is becoming the new path to growth? Something to consider.